intro about myself again to anyone who's listening in. So I primarily see myself as a fundamental investor who's started looking at technicals over the past couple of years. So in the early part of my career, when I was a standalone investor who was purely investing my own money, I would say that investing was fairly simple because there's a whole bunch of things that you can actually do without coming under any sort of peer pressure. So I was primarily a small and micro cap investor. The bigger bulk of my serious investing phase, I would say, started in 2010. 2010, 2011 is where the serious investing phase actually started. So over a period of time, as we started managing third-party capital, so what we realized is that we needed to become, I would say, a bit more market cap agnostic. So as of date, we manage mostly multi-cap portfolios, and our personal capital is sort of aligned with the approach that we use for our external investors as well. So over there, a little bit of a disclaimer, given that there's a whole bunch of regulatory, upgrades that keep happening from the SEBI side. So the talk that I'm about to give next is not an endorsement of the business that we run of any sort. We understand that this is primarily a knowledge sharing platform, and whatever we say over the next hour and a half should be seen only in that context. And given the fact that we are, I would say, investors who have skin in the game, who put our own capital to work in addition to the external capital. So you will see us quoting a whole bunch of, I would say, real-time examples. So each one of them should be seen only as a practical example to try and drill home a certain concept that we are talking about. So with this overall, I would say, context, I would probably want to get deeper into the content that we have planned for today. So in a sense, once again, going back to my experience as a primarily fundamental driven investor for more than a decade now. So I guess there's various aspects to going about the entire thing. So I guess everybody understands the market cycle. So last 2 years we've been through a phase in India and across the world where I guess getting the macro call right has been more important than getting the micro call right. So investors tend to obsess over macroeconomic variables, interest rates, what exactly are the central banks doing, are the emerging market central banks like the Indian central bank aligned with what the US Fed is doing, what's happening on currency, what's happening crude and whatnot. So these are parts, I guess the market has definitely taught us a lot of lessons over the past, I would say, 1.5 years. Then we have something known as the business cycle. So when we look at a particular stock, obviously it is backed by an underlying business. So when we say the business cycle, we are talking of what exactly is happening to the underlying business. So this is where investors usually try to outdo one another in terms of trying to understand the business quality, management quality, and then you try to get the 1 year, 3 year, 5 year projections right for revenue, PAT, cash flows, capital efficiency, and how will the competitive structure actually change for that particular business under question. So this is purely, I would say, the fundamental research on this part. And then comes, I would say, the final part, but the most important part when it comes to the investment outcomes is actually the stock price cycle. So when we say the stock cycle, we are referring to what exactly is happening in the stock price. So top down, you have the market cycle, you have the business cycle, and then you have the stock price cycle. Now, this has been my experience of reading a whole bunch of literature that is out there, including some of the best known investors in the US, some of the best known investors in India. So, generally, the perception that people tend to have is that there's a lot of talk about understanding business quality, getting it right. But then business quality tends to, dominate the investing outcome, I would say, over the long term. So time frame becomes a very, very important factor to consider based on the investor's time frame. Now, as we understand, not every investor has a 10-year or a 15-year time frame towards investing in equities. So in fact, I would say a very, very minor proportion of even seasoned investors would fall into that category. Most investors, I would say, are probably clustered into that 1 to 3 year sort of a horizon, if you keep aside, let's say, the trading part of it. So what generally tends to happen is this, that there's not enough attention that is actually paid to the specific stock cycle by the fundamental investing community, because the narrative is that if you get the business quality right, if you get the management quality assessment right, if you believe you are in a business that has tailwinds over, let's say, the next 10 years, 15 years, 20 years, eventually you're going to make money. However, that doesn't ensure that you're going to make money in the first 3 years of investing. And as we know, applying principles of basic chaos theory, what you do at time t is equal to 0 has a lot of bearing on your decision making by the end of the second year or the third year. It is much easier to hold through a stock where from your entry point you see a little bit of a price appreciation. Then let's say the stock goes into a period of consolidation for let's say 2 years, 3 years. It is still easier to hold on to you are hit with a 30% notional loss for the next 2 years, 3 years, it tends to be a very, very painful sort of an experience for fundamental investors. So on one side, sometimes you see the business fundamentals actually either staying intact or you see them, let's say, slightly worsen, but the long-term prospects of the business don't really change too much. But holding through a stock is not easy in the face of, when there is no feedback loop that is coming to the market that you're actually on the right path. And generally, if you sort of crunch the numbers and see how the and in a market, what tends to happen is the stock price obviously it takes inputs from the business cycle. In fact, you could say that the stock price tends to front run the business cycle, usually by about 2 quarters, 3 quarters. I mean, you can see anecdotal examples around you. The price changes tend to happen first, and then the fundamental changes actually start to fall into place over the next 2, 3 quarters. So this is my experience, which I would say led to some amount of sub optimization over the past, I would say, 7, 8 years. Still, we actually started to correct this entire thing. So the crux of this talk is actually going to be about this. It's actually going to be about this saying this particular underrated aspect of fundamental investing. How have we gone about dealing with those frustrations? What is it that investors can do to improve their outcomes because of this particular video? So on that note, one of the bigger questions that I think everybody is pondering right now, given what has played out in the Indian market and to some extent in the US markets as well. So there's this entire romanticism that's associated with businesses that are secular in nature. So secular businesses, what do you mean? You mean these are businesses where you think the industry structure is pretty much favorable. The company has a very, very dominant competitive position in its chosen area of operations. And then you have revenue growth, you have PAT growth, which is inherently more predictable compared to, let's say, some other businesses. So the bet is this: if I get into a so-called secular business today, and if I can hold through a period of, let's say, 5 years, 10 years, 15 years, whatever it is, the probability that I will be able to exit at a much higher business valuation is going to be much higher because the business itself would have grown in a predictable manner. But are these secular businesses linear performers? Not necessarily. I mean, if your time horizon is 10 years, the answer would probably be yes. But if you're talking of a time period of, let's say, less than 5 years, if you're one of those average investors who's clustered into that 1 to 3 year time frame, what we have seen is that even buying a secular business is not a guarantee of you getting above average performance in the medium term. So this is something which every investor in India has sort of grappled with over the past 2 years. So ever since the market peaked out in 2021. So just go back to the themes that ran very well between 2018 up to 2021. So any market leading business would get re-rated. It would trade at a very, very high valuation. So you had the leading private sector banks, you had consumer stocks, you had certain IT businesses. So the best businesses in the country. But then the question is, if you went and bought all of these businesses in 2021, does that mean you are sitting at a good investing outcome as of today? The answer is clearly a no. And it's not just about the last 2 years. We have some data points over here. So we'll just take, let's say, a few examples over here. So let's start with one of the best businesses in the country. So you have Hindustan Unilever, FMCG company, consumer, secular business, MNC pedigree, asset light, very, very high ROC. Everything is a given. Negative working capital as well. So HUL, if you look at the return that it has delivered over the past 3 years, it is closer to about 9% per annum. Decent return, but then nothing great. But the moment you measure the 10-year return, it is closer to 16%. Okay, what does that mean? It means compared to its usual rate of delivering a return, clearly it has underperformed in the past 3 years. Now let's look at a stock which is probably completely the reverse of HUL. So let's look at ITC. ITC last 3-year return is 30% per annum. But if you look at the last 10-year return, it is hardly 7% per annum, which means your money was better off sitting in a fixed deposit or in a 10-year government security rather than being invested into ITC in either 2013, 2014, 2015, whatever it is. You would have clearly underperformed whatever the even the index delivered to you. Okay, let's look at HDFC Bank. HDFC Bank, as they say, every quarter HDFC Bank is now adding a new Kotak Bank. So that's the size and scale of the behemoth, and this is even before the merger with HDFC Limited has actually gone through. So clearly one of the best banks in terms of asset quality, in terms of having a cross-selling culture, in terms of delivering that 18%, 20% YOY growth. So HDFC Bank return over the past 3 years, 9% per annum. If you consider the 10-year return, 17% per annum. Now let's look at a stock which is obviously not a well, I would say, acknowledged secular business. So let's look at L&T. So clearly it's a domestic capex player, it's an infra player, it's an EPC player. So L&T, 34% per annum is the return over the past 3 years. However, if you take a 10-year return, it's closer to about 12%, 13%. So what does this basic anecdotal, I would say, even a very, very superficial analysis, if you want to call it that, what does this tell us? It tells us that even if the businesses are not very volatile, stock returns are usually volatile most of the time for even the best of the businesses. I mean, this is absolutely undeniable. This is what the data basically tells us. Okay. So then the corollary from this, once you start thinking, let's say at the next level, investing outcomes depend to a great extent on which part of the cycle are I actually hopping onto a stock and when do you actually hop off. Okay. And this is something which a lot of, I would say, institutional investors agree as well. They may not say it openly, but this is basic arithmetic. So now, when it comes to, let's say, something like a basic passive investing, index investing, what index investing tends to do is you just take, I would say, automatic exposure to a particular index. So an index will obviously average out this stock cycle component for the largest businesses in the country. And that's the reason why you end up with, let's say, a sort of a mean or a median sort of a return of around 11%, 12% per annum over the past 5 years. So looking at all of these things, what we have seen is over the past 5 years. So one thing is obviously what is happening in the market, what is happening in the businesses, what is happening in the market. And then there are certain narratives that sort of get built on it based on this. And those narratives are pretty cyclical as well. The narrative that was prevalent between 2014 till about 2018 was totally different. 2014 to 2018, nobody wanted to even touch a large cap stock. People said small cap, micro cap, you can keep compounding at 25%, 30%. That was the narrative. 2018 onwards, nobody wanted to touch a small cap. So what are the narratives that are sort of, being set as part of the previous cycle? So the cycle we are talking of is from 2018, you could say till about 2022. It's a 4-year mini cycle. So generally what people say is it is the amount of time you spend in the market that actually matters. But does that necessarily mean that the timing doesn't matter? Okay, so that is something that every investor needs to sort of ponder over. The whole point is that timing the market is not going to be easy, but it is not that it cannot be done. There are people out there who do a pretty good job of it. Obviously not 100% strike rate, but even if you can get things right 60%, let's say even 70% of the time, you can do a phenomenal job at it. So time in the market obviously matters. Nobody is going to be doubting that. Nobody is going to be questioning that. But to extrapolate that, to say that the timing doesn't matter, I would say is a little bit naive. It's a little bit naive, and I think it's a little bit, I would say there's a little bit of, I would say, intellectual dishonesty over there as well, if you go purely in terms of the data. And the second thing, people talk about business quality, management quality, as if they are the only things that matter. They obviously matter a lot. Over the long term, they are the biggest determinants of investing outcomes. But if BQ and MQ are all that matter, then how do you explain the difference in return from holding the same stock for different periods? I mean, look at HUL. Last 3 years, 9%. The rate of, I would say, the earnings growth has not substantially changed, right? So 10 years, it is 16%. So how do you explain this difference of 8%, 9% return by holding the same stock, which has the same management and the same business quality? So you look at, let's say, some of these reports that are given out in the market. I mean, an 8% outperformance is mind-blowing, even in the Indian context. You have bulk of the funds which are struggling to beat their chosen benchmarks. So if you can have a fund that actually delivers, forget 8%, even if you can squeeze out a 3%, 4% alpha over the chosen benchmark over a 3-year period, you would have done a fantastic job. And one of the things that we tend to we don't forget that, it's just that we tend to reduce the weightage that we give to that when we look at some of these narratives. Investing for the most part is a social science. So investing is not an absolute science. Other investors' behavior for the large part is going to be determining the return more than our analytical ability. Now, if we don't have analytical ability, obviously we're going to be in a very, very bad situation. But the primary determinant of the return is going to be how do other investors behave. So even if you are a pure play textbook fundamental investor, if you do not have a framework that helps you to at least assess, if not predict, how are other investors behaving right now, how have they behaved in the past, what are they likely to do in the future, and what exactly do I need to watch out for. If you don't have that sort of a framework in your mind, it's going to be very difficult to beat the market, in which case you're better off just going and indexing it. So if you look at simple principles of technical analysis, trend following, what does it drive? Trend following basically says you latch on to a trend that tells me this is what the market is finding favor with right now. Okay, you may agree, you may disagree, but you can't disagree with the price, right? So that's the collective wisdom of the crowds, which can be wrong, which can be right over multiple time frames. But investing is primarily a social science. Now, if we look at it that way, so if you just read between the lines, apply your own mind, so effectively the one of the conclusions you will kind of draw is that the stock cycle matters a lot in determining the return that one makes from a particular investment. Okay. And the ability to do this right repeatedly over a period of time is going to determine your portfolio return as well. In the medium term, long term, we agree that PQMQ will probably have a higher bearing on the return that you can get. But in the medium term, stock cycles really tend to matter a lot. Now, if that is the case, why do some of these large institutional investors who handle what 10,000, 20,000, 50,000 crores of equity money, why do they not follow these principles? The reason is they cannot be very, very agile. They are restricted in terms of what they can do, what they cannot do. I mean, if you're a large institutional investor, forget a large guy, even if you're running 1,000 crore fund and your mandate is to buy, let's say, 20 stocks, which means each stock you have to put in 50 crores. 50 crores coming into a stock that is not a large cap stock can move the markets by itself. So you talk to a whole bunch of institutional investors, they say we cannot look at technicals. They see value in it, but they cannot look at it because it becomes a self, I would say, fulfilling sort of a prophecy. The price goes up because they are buying. So institutional investors have certain constraints, but then what stops retail investors from actually building this framework? You should always give it a try. If you give it a try and then you give up and then you say this cannot be done, it's a different discussion altogether. But if there is something out there, if it's a narrative that's actually stopping you from doing this thing in the first place, then there is some amount of evaluation that we need to do. So we believe that retail investors, even let's say boutique funds like us, boutique advisors like us, so this is something that people definitely need to give it a try as to can they do it really well. And trust me, this is coming from somebody like me who has held stocks for more than a decade now. So there are certain stocks that we bought in 2011. We still hold 50%, 60% position in that. Our largest position is something that we initiated in 2014. Obviously, that is in my personal capacity. I was not an investment advisor then. I was not managing funds then. But the fact is 60%, 70% of that position, I'm holding it still today. So this is all of this stock is not coming from somebody who tends to churn portfolios a lot. I have held businesses that have not delivered for 5 years, 6 years. So when something like this is coming from somebody like me whose natural tendency is to hold stocks for the long time, so I guess this is something which can be up the alley for a whole bunch of investors who cluster into that 1 to 3 year investing time frame as well. So now that I look back, I would say I didn't have to be a long-term investor in all of the stocks. I had to be a long-term investor only in some of the stories. I was actually better off taking exits in certain stories and then churning that capital into a different set of stocks. If I had done that, my rudimentary assessment at a pretty high level is my return would probably have been at least 3%, 4% per annum more than what it is right now over the past 10 years. So what tends to happen is this: at any point of time, irrespective of what is happening in the market cycle, irrespective of what is happening in the economy, there are always some stocks that are getting re-rated, while some others are getting de-rated. As an active investor whose primary objective is to beat the benchmark over your chosen time frame, an active investor needs to have ways and means that enable him or give him an edge so that he navigates into the right pockets. And corollary to that is you should have the ability to also avoid some of the wrong pockets as well. Now, I want to end this particular section of the talk by quoting, let's say, one of the smartest things that has ever told to me. So, a very, very wise gentleman told me, and this gentleman was primarily a mutual fund investor who would do a little bit of, I would say, direct equity investing as well. But then he had seen at least 5, 6 cycles. He's been investing since, I would say, the early part of 90s, since the day India got liberalized. So he said, smart investors should go and buy fallen businesses. You should not go and buy falling businesses. Okay. It looks very, very simple. The statement is very, very deep. Now, when you get around to, let's say, executing this in motion, how do you distinguish a fallen business from a falling business? It is extremely tough if you keep wearing the hat of, let's say, a pure play fundamental investor only. I mean, you will have a certain range of outcomes, but there are certain periods where the profit growth rate falls from 10% to 4%. Certain times, if the long-term growth rate is, let's say, 10%, the business ends up doing 15%, 20%. So you have certain limitations when it comes to, let's say, your fundamental forecasting as well. And you cannot get everything right all the time. How do you make a distinction between a falling stock and a fallen stock? Because that ultimately feeds into your particular return. So the whole, I would say, the takeaway of the first section of this talk is this: any fundamental investor, you need to pay a lot of respect to individual stock cycles. Spend some amount of time in trying to understand what exactly is going on in terms of the stock cycle. Obviously, this follows after you have done the fundamental work, because this can make a huge difference to your return in the long term. Even if over 5 years, a return of, let's say, 3%, 4% per annum more than what you're doing right now is pretty huge, as and when your capital ES actually starts going up. So over here, I guess we're kind of 20 minutes into the talk. I just want to take a checkpoint. So happy to hear any personal experiences that you people have had, or you have any questions on what we've sort of spoken so far. Yeah, absolutely. So in a sense, I'll be covering that as part of the next section of the talk. But before that, so has the echo gotten better, or is it still kind of, it's much better now? Oh, okay, okay, thanks for that. Okay. So in fact, so what you asked is obviously a very, very important part of the entire thing, because we're not theoretical investors. So when we pick up a particular topic, we always want to think through how are we doing it and how should other investors do it. So I'll be very happy to cover that in the subsequent sections of the talk. So let me just pick up from where I kind of left off. So just now, bunch of, I would say, practical observations about what's been happening in the market, so that it helps us place the entire context for what we have been talking about. So if you look at which are the sectors that have delivered the best return over the past 1 year in the Indian market, so economy facing sectors, so capital goods has done pretty well, infra has done pretty well, industrials have done pretty well, lending as a pack has done pretty well. So I guess there was a cycle where PSU banks were kind of leading the entire market. So then you have tier 2 lenders that are actually doing pretty well right now. Last 2 months, just look at what's been happening to microfinance stocks. So everything is kind of it has been on a tear, right? So look at some of the newer trends like electronic manufacturing services, which has been on a tear over the past, I would say, couple of months, where stocks have gone 40%, 50%. Okay. Then you have the surprising part is this: some IT companies have done very well, which are outside of the usual list. The large cap, I would say, the usual mid cap IT companies have been still struggling. But if you look at some of these IT companies, like let's say a Newgen, let's look at a Zensar Tech, now look at an R Systems, and within the larger pack, I would say look at Persistent. So the thing is, what are the common things to these packs that have actually done well? So this is where I guess the cyclicality, once it becomes very obvious at a sector level, a good chunk of it translates to the particular businesses as well. So this is what we have observed. I mean, this is an observation that you can make across cycles, and our suggestion is do it real time. If you are kind of slightly early in your investing journey, do it real time. Always maintain notes saying what has happened in 2021, what's happened in 2022, what's happening right now, what do you think will happen in 2024. 5 years later, when you look back and actually read through this, I would say this entire diary or that entire log that you're maintaining for yourself, that itself is kind of going to tell us the areas that we are strong at and the areas that we are weak at. So this is what you can observe. Stocks tend to move as a pack. So sector does well, stocks generally tend to do well, right? So this indirectly, confirms what we've been talking about. Cyclical returns, almost every single sector, even if the underlying business trends are very, very steady. So FMCG, if you actually keep aside ITC, Britannia, a couple of, let's say, outlier names, the rest of them haven't really done all that much over the past 2 years. I mean, they've given you a positive return, but it's nowhere close to their historical return, right? So if you can take a sector like an FMCG, if you can take a secular business like an IT, and then you see that the return is, kind of cyclical from them. So the bigger question is this, then how do you go about assessing where the sector is right now in the cycle, right? So the first point being everything is cyclical. It's just that the cycle tends to be short for certain sectors and for certain businesses, whereas for certain businesses and for certain other sectors, the cycles tend to be really, really long. So you can have outperformance for 4 years, 5 years, and then you kind of go into a lull. 3, 4 years, you kind of do nothing, right? So other thing you can clearly notice is medium-term outperformance. The bulk of it actually is coming from the right sector allocation. So in 2022, if you avoided pockets of, let's say, IT, avoided pockets of chemicals altogether, and if you were able to come into these right sectors, the return automatically would have taken care of itself. It doesn't matter if you bought the best business or, let's say, an average business or, let's say, a tier 2, tier 3 business. End of the day, you have made money. Okay. Your risk adjusted return may not be very high, but the absolute return definitely is there. And as the market goes into, let's say, a positive cycle, a positive run, bull run, whatever you want to call it, we have seen some investors do this very, very well. Stock rotation within the stronger sectors. Just figure out what the stronger sectors are. Do stock rotation within that. The tier 1, tier 2 companies get priced in very, very fast. So you will not be able to buy them cheap. As the bull run matures, the bulk of the return is going to be coming in from, let's say, the tier 2 and the tier 3. That doesn't mean you go and buy a loss-making company, you buy a tier 4 business. That doesn't make sense. But subject to whatever quality criteria you have, sector rotation, number one. Stock rotation within the stronger sectors, usually it works very, very well till the trend actually changes. Now, the bulk of your outperformance over the medium term, it is actually going to be coming from the stock re-rating part. I mean, this is something that's very, very obvious, that is very, very kind of, done to that. But to take a few practical examples of what's happening. So let's take a story like Page Industries. So Page Industries, just take the peak that it made in 2018. 2018, I remember the stock was trading at something like 90p because their numbers were pretty brilliant. 18%, 20%, 22% growth, margins improving, everything is fine. But if you measure the return that you made from that particular peak, I think the return is actually less than what you would have made if you had placed money in an FD. Which means what? The business has done well, but you entered at the wrong cycle. Now that is obvious with hindsight. Take another example. Let's look at an Abbott India. So Abbott India till about 2019, we believe was probably trading at what? I think 34, 35 PE. Once in a while, it would trade at around 40 PE. Now, Abbott India 3-year PAT is what? Close to around 17% right now. The stock CAGR is just 10%. But the moment you consider the 10-year track record, the 10-year PAT is 21%. Stock CAGR is 31%. So, which means the re-rating part has actually accounted for a whole chunk of your return. Now, even in the best performing investments that we have in our personal portfolio, I would say the earnings has gone up from what, 60 crores to around 600, 650 crores. So that's a 10x that's actually coming from the earnings part. And then we have a re-rating that has taken the stock from 11p to around 45p today. So the re-rating part has given us around 4x. So this re-rating determines outperformance for the most part in the medium term. So in terms of, let's say, physical concepts, you need to see this as acceleration versus speed. So you can have two, let's say, vehicles going at the same speed, but one vehicle is accelerating, the other vehicle is, let's say, either steady or it is decelerating. So without doing too much of math, it's very obvious to figure out that, let's say, 10 minutes down the line, they're going to be at a totally different sort of a trajectory. So now, how do you kind of place this within a particular framework? Now, the thing with fundamental investing is this: there are unfortunately no clear cut frameworks or no clear cut answers to everything. You talk to a great fundamental investor, he says it depends. You're supposed to assess what's happening in the overall market. You're supposed to assess what exactly is happening to the capital flows into that particular industry. Profit pool, is it expanding? What is happening to the competitive position? Then you're supposed to understand what exactly is the management quality of the business. Is it getting better? What's happening to the business quality? What kind of investments are they making? Now, most of this is qualitative information. Okay. Now, if you hop onto the other side and let's say you look at a basic market expansion and a contraction framework, you can, I think TA talks of this, any sort of a macro theory talks of this. So very, very simple framework. So in TA, you have the stage 1, stage 2, stage 3, and stage 4 stock. And as they say in TA, you never hold stage 4 stock. So as a fundamental investor, the bigger job that you have is you should be able to take the current context of this particular business, of this particular sector, and you should be able to sort of, at least to come to some sort of a overall assessment saying exactly where is this business sitting. Are you coming off a phase of, let's say, pessimism? Are you coming off a range bound consolidation? So once you figure out where the stage is, which stage the particular business is kind of sitting in, it tends to make your decision making very, very easy. Now, I would actually go one step further compared to what a TA framework tells me. So TSS never hold stage 4 stocks. Now, counterintuitively, what really kills fundamental investors is when you enter into a stock which is into stage 3. So, stage 3 is where there has been a very good run up in the stock for a few months, or let's say for a few quarters or a few years in the case. And then you start to notice that the results are coming in fine, but the stock price doesn't seem to have any sort of velocity. So, the earnings goes up 25%, but the stock price doesn't move too much. Okay. Now, if as a fundamental investor, if you take a rear view mirror approach, okay, if you take purely a fundamental approach, if you take purely a rear view mirror approach, what tends to happen is you will see what is the earnings growth rate over the past 3 years, 4 years. It looks good, fine. You tend to look at management quality, you tend to look at business quality, market share, put in whatever framework that you want to. Look at capital efficiency, look at operating cash flows. Everything looks absolutely brilliant. It's just that the stock price is not reacting to very good numbers. Okay. In such cases, and trust me, this is a mistake that we have made in the previous cycles as well. Okay. It looks very, very obvious. It looks very, very simple, but trust me, mistakes are always made because in a bull run, you're always looking for, you're always looking to where to deploy capital because sitting on cash is going to give you a drag on the performance. So some of the biggest mistakes happen in a bull run. So in a bull run, when there is so much of implicit pressure that the market's actually putting on you, the biggest mistakes happen when you take a look at the trailing, let's say, 3-year, 4-year performance of the stock and the particular business. And then you will see what is the current, let's say, PE multiple. You look at the current PE multiple, which seem to still be in the historical average. So let's say a business generally trades between 35 PE and 45 PE. Currently, the business is trading at, let's say, 40 PE. So you will kind of rationalize it saying, okay, I'm not buying something that is very, very expensive. And then you say, this is fine. I like the business. I like the trajectory. I'm going to get into that. And then you get stuck in a time correction for 1 year. And then the stage 4 begins. So that is where the stock price starts falling. And then the fundamentals start soaring with a lag. So getting in at stage 3 is actually a death knell for a fundamental investor. This is what I've understood. And at the peak of this cycle is where any sort of a good technical framework is going to add the maximum value. So this is once again counterintuitive. TA in stage 3, if it helps you identify, saying you're now going into a consolidation, there are clear signs of, let's say, distribution. Okay, then that will prevent you from making this error. Whereas at the bottom of a cycle, if it's a stock that has already fallen a lot, just look at the history. Just look at the history of, let's say, the stock price. Just look at the fundamentals kind of, deteriorating. You will see that the business cycle has kind of, flipped. Classical example, what chemicals stocks are going through right now for the past 2 years. So at one point of time, you had like what API businesses reporting 25% EBITDA margin. You had amines businesses reporting 35% EBITDA margin. Today they have just mean reverted. So amines business at least has mean reverted only to 20% EBITDA margin. Whereas if you look at some of the API makers, people have been reporting what 8%, 10% EBITDA. Q4 some numbers came in at 12%, 13% EBITDA. So you will see that the stock price actually bottomed out much before the fundamentals bottomed out. So it helps to kind of place you, give you some sort of an overall placeholder in terms of what exactly. So this sort of framework, how can you use this kind of a basic framework that enables you to ensure that you're not making big mistakes? So if you can get to a strike rate of let's say 60%, 65%, I think that's kind of that's like that will hold you in a very very good position if you can avoid those real last mistakes. So I would take things one step further just to reiterate what I'm saying. Technical analysis will tell you that never hold stage four stocks. It's absolutely right because that philosophy or that discipline doesn't really do too much of fundamental analysis. But for a fundamental investor who doesn't look at trends, who doesn't look at technical analysis, the problem is you will end up buying a stock that is in stage three. Then you suffer with time correction. Then you suffer with a price correction. And one stock like that, which falls, let's say 30%, 40%, it kind of takes away the alpha that is generated by a whole bunch of others. So this is kind of, something that every investor needs to sort of work towards. So post this, I guess the next section of the talk is going to be more in terms of how can a retail investor actually go about doing this entire thing. So we're going to be giving you some basic practical methodologies which we have been using for the past say 1.5 to 2 years, and this is something that we have tested out over the past 2 years with real capital, and it seems to be working well. But I would probably want to take another checkpoint over there and see if anybody has any comments or anything to offer. Yeah, so in a sense, the first suggestion obviously would be that somebody, a retail investor, can actually have some amount of proficiency across both the disciplines. I mean, both the disciplines. So if you are somebody who's been doing only fundamentals so far, even if you have done a very good job at it, spending let's say 10% of your time understanding the basic framework of technical analysis. I mean, you can continue to run your entire portfolio based purely on fundamentals, but the very fact that you're using a different hat to sort of look at the entire thing, because look at it this way. See, this is the conclusion that I have come to after doing some amount of study on technicals and a whole bunch of fundamentals. Eventually it is earnings and fundamentals that drives the stock prices. What is technicals? Technicals just tells you who's coming in, who's exiting, what is the supply demand situation for that particular stock. That is all that technicals tells you, because at its very very bare bones, forget complicated concepts. And to be honest, I haven't studied complicated concepts so far. Just look at price in combination and volume, plot a basic moving average, understand basic candlesticks. That's all. That is all that one needs to do. And this is something that can be done over a fairly rudimentary study over a period of 6 months. So that would be kind of my first suggestion to anybody who's kind of grappling with this particular sort of an issue. Okay, sure. Let's do it that way. So in a sense, what is it that we have been, sort of doing? So over here, I will probably want to give a view in terms of how we manage portfolios as well, because ultimately the unit of measurement for any investor is the overall portfolio return, right? I mean, I can do a fantastic job in let's say one or two stocks, but if I don't do a great job with the rest of the portfolio, your investing outcomes are not going to be all that great, right? So in a sense, from a portfolio point of view, what is it that I think we have probably fine tuned and are doing better after having this particular perspective. So the first thing that people can actually do is just look at the relative strength of sectors. I mean, this is fairly simple. There's a whole lot of people out there who will make this kind of a report available to you. So if you're a retail investor, the first starting point should be this. Ask yourself, is your coverage across sectors really up to the mark or not? Usually, an honest assessment will tell you that you're probably not there yet, because one single person acting as a silo, it is going to be extremely difficult for that person to understand IT, understand pharma, track logistics, understand hospitals, have a view on EMS, track a whole bunch of things. So if you don't really have that sort of a fundamental view on most sectors, then what happens is there are certain areas of strength that you already have. But how do you figure out, given that you have a paucity of time, where should I be focusing my efforts next in terms of catching the next big thing? So that is where just look at a simple relative strength report across sectors. That will tell you where is the positioning actually changing for the better. So just go back to 2022, relative strength started showing up very, very powerfully in all of these economic sectors. Capital goods, infra, industrials, whichever pocket you really want to focus on, it started coming up in all the relative strength. So once we saw that this was coming week after week, week after week, we straight away knew that this is where we need to focus the rest of our energies. So 2022, believe it, we had zero exposure to that particular thing. But once we saw this entire thing, we said something seems to be happening over there. That the fundamental numbers are okay, they are getting better, but it's not exactly that the numbers are brilliant yet. But the price moves once the smart money starts to actually come in. So whether it be institutional money, whether it be the smart traders or whatever it is. So this is how you can actually figure out where you want to spend your time as a fundamental investor. And generally, what tends to happen is this: your probability of success is going to be much, much higher in any 1 to 3 year cycle if you can be in the strong pockets. So today, let's say you buy the 10th best business within industrials, infra, and capital goods as a fact, and you buy the best business within chemicals any day, in spite of the difference in the business quality, the 10th business within the strong sector is probably going to beat the return of the best business within a weak sector hands down. So this is something that we have learned with experience. So you can be diversified in your portfolios, but the most important starting point should be this. You need to track the relative strength of sectors. That will tell you where is the velocity of money actually moving the price the most. And once again, counterintuitively, think of it this way: if you want the price to move, there has to be a delta change in terms of something, right? Either there has to be more number of people chasing that stock, or there has to be a greater quantum of money that is chasing the stock. So either you should have under ownership, or it should be coming out of a very, very long phase of consolidation. You can think fundamentally, you can think technically. And when people put in their money to work, what exactly are they betting on? They are betting on the fact that at some point of time in the next 6 months, 9 months, we are betting on the earnings trajectory going to the next level in this particular sector or in this particular thing. Because end of the day, that is what really moves the market. The technical position of a stock can be very, very strong. Tomorrow, if the fundamental result of that company shows a 50% earnings degrowth, trust me, even the most strongest technical stock is going to take a beating. So it is fundamentals, it is earnings that actually moves the market. But when you track relative strength, it tells you the early movers where exactly is the velocity of money actually moving the stock price. So that I would say is probably a very, very important thing that we figured out. Ideally speaking, we should have done this much earlier. But if you can figure that out, your time as a fundamental investor is going to be spent much, much better. And trust me, once you start researching a new sector, it's going to take you a detailed research of at least 4 or 5 businesses for you to have a view on the overall sector. Because there are some sectors where you have hardly 4 or 5 listed companies. So, for example, you look at paints. How many businesses do you have? Hardly 6, 7, whatever, right? But if you go into capital goods, if you go into infrastructure, you have EPC companies. Within EPC, you have people doing things on the EPC model. You have people doing things on the HAM model. Okay, Then you go into power. You have power generation. You have You have power transmission. You have power distribution. Okay. Then you have people who are into the BTG segment. People who make transformers. People who are making SCADA systems, control systems. Where exactly do you go into? It is going to take you a fair amount of time to actually understand the entire valuation of a sector fundamentally. This is one of the biggest limitations that you will always have as a fundamental investor who's acting as a silo. But if you're a fund manager who has a team of 10 analysts, you can probably be up to speed within maybe 2 months, 3 months at the very most. But if you're an individual who's acting, you need to take the help of all of these technical indicators so that you can figure out where should my time be spent right now. So going back to 2022, we had a choice. Either we could have, let's say, done more research within chemicals, because chemicals stocks had fallen a lot. Okay. Fundamentally, I think we understand things to a reasonable extent. But chemicals was in a bad cycle and it continues to be in a bad cycle. Today, it still continues to be in a bad cycle. So the delta of return on the 20% position we took into these economic sectors, okay, the average return in that particular pocket, I would say, has been close to 70%, 80% for us in the past 1 year. Just imagine how much it has moved the portfolio on a 20% allocation. Instead of doing that, if we had gotten into some other sectors which will eventually perform, our medium term performance wouldn't have been this healthy. Right? So that's the implication for anybody over there. Now, second thing, if you want to take a pure fundamental approach, okay, a pure fundamental approach, just forget all of this technical wala thing. Okay. Within well discovered stories, simple. Just look for stories where the PAT CAGR is significantly higher than the stock price CAGR over the past 3 years. Okay, that's the first condition. The second condition is you will have to see if the 1 year forward PE is actually lower than the long term, I would say, earnings multiple. Okay, now once again, I would like to repeat this. It is about the 1 year forward PE. It is not about what the stock has done in the past 1 year. So this is where you will need to do your work as a fundamental investor, get to the nitty gritty details of it, draw up a model that tells you quarterly basis, annual basis, what is the earnings profile going to actually look like over the next, say, a couple of years. Okay. If you see a delta over there, if you see that the PAT CAGR is, let's say, 12%, whereas the stock price CAGR is hardly 3%, 4%, and you think the 1 year forward PE is probably at, let's say, 20, whereas the 5 year or the 10 year average for the stock is closer to, let's say, 25 to 30, chances are you're looking at a stock that will eventually end up performing. When you will never be able to predict purely on a fundamental basis, but it is definitely a bet that is worth taking. The whole of the deep value investing, it falls into this, where you say, to hell with technicals, I don't want to look at anything, just look at these basic criteria. Okay. The third alternative that fundamental investors can use is some of these, I would say, platforms give you something like a reverse DCF functionality. Okay, use the reverse DCF functionality to check what is the embedded growth rate that the stock price right now is discounted. Compare that with respect to, let's say, the historic long-term growth rate. Okay, and this approach specifically works very well for stable industries. Stable industries like, you could say, IT, you could say consumer, you could say even building materials for that matter. It tends to work very, very well. In fact, this has been one of the exit criteria that we have been using so far successfully to some extent. So just to give you a practical example, if you look at, say, Cera sanitary ware. So Cera sanitary ware 2011, it was trading at what, 11p, 12p, where the earnings growth was something like 15%, 18% per annum. 2015, the stock price got re-rated to something like, I think, 48 or 50p. Look at that. That's a 4x re-rating of the PE multiple. Earnings grew 20%, 25% over those 3 years, 4 years. But at the top, in 2015, if you had done this reverse DCF exercise, just to figure out what exactly is the growth rate that is being discounted into the stock price. Reverse DCF is all about two variables. Number one, what should be the earnings growth rate and over what period of time. So if the outcome of this exercise tells you that the earnings growth rate needs to be high, so let's say it needs to be 25% over the next 3 years, it's okay. It's still a bet that you can take, provided your fundamental assessment tells you that earnings growth is likely to be very strong in this business for the next 3 years. But the moment you get to a stage where the entire evaluation period stretches to, let's say, 10 years, if a business has to do 20% earnings growth rate, or even let's say 18% earnings growth rate over the next 10 years, it's going to be next to impossible probabilistically for you to actually get the investing outcome that you want without running into a few accidents here. So just do this exercise whenever you can. Just pick up something like, let's say, a screener or whatever tool you have. Ask yourself, how many businesses in India have managed to deliver, let's say, 18% growth rate in profits over the past 10 years? That number is going to absolutely shock. It's a very, very limited number of businesses, and even they tend to have accidents every once in a while. Okay, so these are the three tools that we believe that people should be using. Pick, try all three. Pick the one which you think you will be able to apply very reliably and very, very consistently. So when it comes to, let's say, things like portfolio construction, so we believe that end of the day, it always makes sense to build balanced portfolio. So as an investor, after you have done all of this, let's say all of this exercise, and you have your set of outcomes and insights, the choice you have is this: do you want to be overweight? Do you want to have an excessive allocation only to the strong sectors? And do you want to completely avoid the weak sectors? Or do you want to strike a balance? Which means, do you want to pick a mix of stocks that are at various parts of this cycle? Fundamental rule, once again, avoid stage 3 stock as a fundamental investor. There is absolutely nothing in it for a fundamental investor to buy a stage, unless, so a technical guy can probably play the 10%, 15% bounce in a matter of 2 months, 3 months within that particular range. But there is absolutely nothing in it for a fundamental investor to buy a stock that has already entered stage 3. Okay, so if that's the case, then either you are buying stocks that are very, very strong, okay, where the earnings is good, where everything is working in union, so effectively a stage 2 stock, or you're trying to do bottom fishing, you're trying to buy businesses which have fallen a lot, or let's say in certain cases where the businesses are falling, but you think fundamentally things are going to change over the next, let's say, 2 to 3 years. So the difference in outcome is going to be this: if you take the first approach of buying only stocks in those sectors which have, everything going for them right now, you're building a lot of risk into the portfolio, because that is how factor investing works. When you go overweight, when you kind of over leverage onto a single factor, at some point of time that factor is going to stop working. Then ask yourself, can you be agile enough to be able to reverse your position? The fact is, most fundamental investors cannot be. This is what I have seen. It is very easy to talk of that, but it is extremely difficult to kind of, execute that real time. So the choice that we have taken is this: we have taken a choice to build balanced portfolios. Okay. So there are certain sectors, there are certain businesses that we are definitely avoiding right now. But if you look at the portfolios that we built, it's a mix of stocks that are in stage 2. Some stocks are, you could say, arguably at the bottom end of stage 4. That is our assessment. And then you have a set of stocks which have been in stage 1 for a long period of time. So either we are playing deep value bets where we think fundamentally things are intact and things are actually going to get better going forward, or we are buying stocks where we think already things are kind of working in unison. So in that case, what happens is, even in case of certain accidents, the overall portfolio drawdown is not going to be very, very high. Otherwise, what would have happened is, let's say you had gone overweight on momentum investing in 2021. You were buying, let's say, IRCTC, IEX. I mean, some of these are great businesses, right? Monopolies, everything is absolutely fine. Numbers be a chat. But if you get caught, you lose 10%, 15% in a absolute matter of time. So these are the inputs that we have in terms of, where fundamental investors could actually start their stock discovery or stock search process. So that is, look for relative strength. Now, within well-discovered stories, you will have to look for places where the PAT CAGR is much greater than the stock CAGR. So that's the second criteria. The third thing, which I think is something which everybody needs to probably give it a try, is see if you can do a reverse DCF. It calls for some amount of modeling skills, but it is going to be something that is definitely worth your while. And finally, when you want to build a portfolio, you need to be very clearly in one of these two buckets. Are you chasing alpha? And if so, do you think you can be agile as and when the trend really changes? If not, we believe you're probably better off building balanced portfolios where you have, let's say, a 50% allocation to stocks that are in stage 2, and then you are taking value bets, because then you will be able to, let's say, prune in stages, you will be able to change the portfolio, you can calibrate real time. So these are some of the, I would say, the 3-4 pointed inputs that we have for retail investors who want to take this approach of understanding where exactly the stock is in terms of the stock cycle, and how do you go about building, portfolios based on this. So I guess it makes sense to take a little bit of a checkpoint over here and see if we have any questions. This way, there are a limited set of businesses in India where the long term trend is secular, but for most businesses the long term trend is cyclical. So that's the first starting point. I mean, you can have certain stocks where, let's say, you have a good run, then it goes into a price consolidation for, let's say, 3 years, 4 years. So classic example being, let's say, a Syngene. So Syngene went nowhere for about, let's say, 3 years, 4 years, right? So that is one particular category of a stock which doesn't suffer too much from price correction at any point of time. So those are ideally, I would say, easier fishing points for investors, though you will not be able to buy that business very cheap. And then there are some businesses where if you see the price chart, it tells you that the business is either the business is very, very volatile. But if you don't see that sort of volatility in the business, you need to understand that the market view about this stock, about this business, about this management, for some reason is not great. Otherwise, you cannot explain a 70%, 80% drawdown in a stock unless you are a small bank. Small banks can fall 70%, 80% in a bad cycle. So I would make a distinction. I would actually pick up the long-term trend of a long-term chart of a particular business and ask myself, which category does this really fall into? Does this fall into this category 1, or does it fall into this category 2? And then, take a I would say, a starting point from there. So chemicals, I believe the market actually didn't care too much for chemicals up till, I would say, 2018, 2019. I mean, there were a bunch of businesses that were doing all the right things. Okay, but chemicals has certain, how to speak purely, let's say, fundamentally. It is not a business where you have high gross asset turn. It's not a business where you end up making, let's say, 20% EBITDA margin most of the time. It is not a business where you operate at a very efficient working capital cycle. So chemicals businesses generally don't deliver a very high ROC. So for that reason, the market said chemicals business, we will trade it between, let's say, 16 PE and 20 PE. It's just that post COVID, I think the market went into a totally different sort of a frenzy, because the raw material movement was very much in favor of the most of the chemical. So they I would say they gained from this entire so-called China plus one narrative. They gained from the possibility that people wanted to now consider certain alternatives to their supply chain. And once you're sitting on a fair amount of inventory gains, so then the market started to, I would say, extrapolate, saying the margin profile has changed fundamentally, which has kind of, reversed itself right now. So coming to chemicals, I think in the current situation, some of the chemicals players that have the ability to structure long-term contracts with their customers and who are playing into areas like, I would say, fluorine chemistry, they are well placed, but they are kind of priced to the rim. Most of the other chemical stories, barring aside a few, I would say, outliers like PI industries, most of them are still kind of struggling. So chemicals, fundamentally, things are still getting bad. They haven't gotten better. There are still no tangible signs that fundamentally things have bottomed out. Technically speaking, they are in stage 4 as well. So one needs to be absolutely sure about what he's doing right now. If you are adding exposure to chemicals right now, I can understand if somebody is doing it saying I have a 5-year horizon. At some point of time over the next, let's say, 2 to 5 years, I think things will fall into place. But if you are somebody who's expecting to, let's say, deliver good investing outcomes over the next 3 years, you have to be absolutely sure about of what is the bet you are making and which is the particular business that you're most interested in. So you need to tread very, very cautiously. That is what I.
Hi. Uh, do you use technical for exit also?
Yes, yes. In fact, yes. So when it comes to an exit, sir, once again, I'll have to give you a bit of a context about what are the challenges that we've traditionally faced in the past. If you look at it purely fundamentally, at the peak, everything looks brilliant. Everything looks brilliant. The narrative says this management is really great. Earnings growth is very good. Everything is, on track. So exit, we actually consider technicals a lot when it comes to stocks that have already done very, very well. So once again, to give you a practical example, so a practical example is we've been holding Apar Industries for the past, I would say, almost 1 year now. So Apar, if you look at it this way, the technical trend is pretty interesting. It's actually pretty interesting right now. So just go back to, let's say, the Q3 results. Okay, go back to the Q3 results just before. The stock gave a massive shakeout. I think the stock fell from something like 1800 rupees to a bottom of around 1400 or maybe 1350 in a matter of, I think, a week. So that would have shaken out a lot of technical hands, but we were very, very confident in our fundamental analysis saying numbers are probably going to get better. So this is something that we need to ignore. So we decided to hold on. Fundamentals came in. The stock then went into the next trajectory. Now go to the Q4 result. Q4 result was spectacular in every sense of the term. But look at the market reaction. Look at the technical candle that was formed on Q4 result day. Then look at the big sell-off bar that came the next day. So I still remember we had sent out a note to our subscribers on that particular day. So what we actually did was we said this is the first sign of distribution. The first sign of distribution occurs when you have a very, very good quarterly result, but the management, let's say, starts to caution on something saying, hey, you should not extrapolate this. And to give credit to the company management, they've been saying this for a long time. But that is when the first set of proactive, prudent selling comes from institutional investors who say, okay, let me take some money off the table. So that explains the candle that was formed on the particular result day, and you see the dip on the very next day. So we too went and did some sort of, let's say, a risk management based pruning, but we still continue to hold a decent size position over there. And if you see the stock price movement that has happened in the past, let's say 4 or 5 days, I think in a weekly chart, this is probably the highest close that the stock has given, not on a daily sense. So that means even the exits can be planned in a phased out manner. To give you a very, very practical example, so I believe technical should be given a greater amount of credence after a stock has done very, very well. Whereas at the bottom of a stock, I think it is more about fundamentals rather than technical. This is the framework that we have sort of evolved into over the past 1.5 to 2 years. No, I mean, there are no wrong questions. So I would once again look at it this way. So generally, when the smart money enters, it is usually institutional money, correct? So when an large institutional ticket size starts coming into the particular counter, first thing you should look for is a clear-cut change in the volume profile. So if the average volume for, let's say, the past 1 year, 3 year, 5 year is, just to take a number, let's say it's 100,000 shares per day, and then you have a volume spike that is coming in, which clearly tells me that the buying force is sort of overwhelming the selling pressure that the stock has, then what you will see is you will see a huge volume bar for 3 4 days, which will be accompanied by a near vertical price and rise. Now the thing to notice is this: if this sort of a pattern comes, let's say after a stock has consolidated for a long period of time, so which is why we give a tremendous amount of, I would say, weightage to stocks that are showing a 3 year, 5 year, 10 year breakout. So if a stock is breaking out after, let's say, a 5 year period of consolidation on very, very strong volume, that tells me there is something that is happening over here, which a smart fundamental investor has figured out. It is a signal for me to actually go and do more work over there and to apply my fundamental mind and to understand what exactly is changing in this. So yeah, I think that's the way we would look at it.
Hi, thanks, Prince. Hi, Kedar. Bhai. So, you were just talking about having a mix of sort of momentum plays and pessimism plays in the portfolio. Momentum and pessimism both from sort of fundamental point of view, not really from technical. So, in that context, I wanted to get your views on two particular industries. One would be the brokerage industry, so sort of stocks like Angel One or ICICI Securities and all these brokerages, and the other would be say the innerwear company like Lux, Rupa, Dollar, all these companies. So where would you put them exactly in this, the cycle that you were talking about?
Mm-hmm. So I'll take the second sector first because I think it's much simpler over there. So if you look at all of these innerwear companies, so I guess what happened over the past 1 year is this. So yarn prices sort of went up 70% in a very very short duration of time, and then closer to Q3 is where the yarn prices sort of fell very very sharply. And for a whole bunch of these companies which are overly reliant on distribution compared to, let's say, an EBO strategy that a Page Industries pursues, so they didn't really have a choice because Q3 you saw that sharp fall in both the volumes and the realization, right? So this sector is, I think, in my assessment, it's probably a classic case of pessimism, because contrary to what anybody can say, this is not the sort of category or consumable where the volatility is going to be this high. And what gives me credence to this entire line of thinking is we need to make a distinction between primary sales and secondary sales when it comes to consumer business. In certain quarters, what happens is the distributor refuses to take delivery because they think prices are going to fall further. You will see this happening in, let's say, the PVC pipes industry as well. There are certain quarters where the primary sales just fall off a cliff, but the secondary sales may see a little bit of a slowdown. So I think innerwear is a classic case of a lot of pessimism. I would say not right now, but the pessimism was there in Q4 in terms of the stock price. In terms of the business, if mean reversion plays out, let's say Q1, Q2, Q3, whenever it is, I think eventually these are the sort of categories which have a very stable sort of a margin profile. The demand may, let's say, fall from maybe 10% to 7% because of inflation, because of the broader economy not doing well and all of that. But the margin profile and the unit economics doesn't really change. So I think this sector is probably a classic case of pessimism that is kind of going on right now. Now, when it comes to broking, it's a far more, I would say, an interesting sector that way, because broking is a stereotypical classical cyclical sort of a business. And if you study the unit economics of all the leading brokerages of the country, till 2 years ago, 3 years ago, the entire correlation of the revenue was mostly to the cash volumes. So cash volumes do well, these guys report very, very good numbers. If cash volumes don't do well, cash ADTO starts falling, their revenue numbers start falling. Last 2-3 years, the bulk of the ADTO is actually coming in from the F&O side. So contrary to the market performance of the past, let's say 1.5 years. So I think the revenue from the cash segment, if you plot the trend, it has not been very great. It has been cyclical, but it has been sort of compensated by the trend that we are seeing in F&O volume. So in this case, you need to sort of juxtapose a lot of things. You need to tell yourself saying the fundamental drivers of this particular industry seem to be changing for the better, because every single player out there is going out and getting an AMC license or launching a PMS or doing wealth management. So fee income is something that they will definitely sort of keep growing over a period of time. So that is one good change that is happening in the entire industry. The other thing we need to see is that the industry still continues to be cyclical. So it's a fairly complicated sort of a setup right now. So I would say it's very, very stock specific and business specific rather than the overall industry. So the view could be different for an Angel One, it could be slightly different for an ICICI Securities, and totally different for a story like a Motilal.
Got it, Kedar bhai. If I can ask just one follow-up question on that. So, do you think this F&O boom that we are seeing, what are your views on sort of sustenance in that regard? Is this like the Indian retail market sort of maturing and therefore these volumes are going to sort of stay? Because like you said, cash has shown cyclicality, but F&O volumes haven't. So how do you see that, and therefore implications for, as you said, players like Angel One could be a very solid story, right?
Yeah, it could be. So I think right now the entire increase in volume that we have seen on the F&O side, it's probably because of wider and broader participation. And interestingly, there's a lot of, I would say, new generation people who seem to have entered the market because of smart digital marketing by some of these players. They have directly started in F&O. They have not done even a single cash trade so far. Their first trade is an options trade, right? So now the second question I would probably want to ask myself is, what is the staying power or what is the sophistication level of these investors? Because F&O at the end of the day is a totally different animal, right? Anything that has embedded leverage there is always the possibility that individuals will kind of, blow up on a single trade. You could have things working very well for 3 years. One simple, let's say, gap down opening by the Nifty, it is going to sink a whole bunch of people. So that is where a little bit of concern comes in, because the broader participation, obviously, it's a very, very healthy trend. But do they really have that sort of sophistication and that sort of staying power is something that we need to qualitatively evaluate over a period of time. So I don't know if I have a ready answer to that. My preference, if I could maybe talk about that, is probably to look for somebody who's able to cross-sell a bigger set of services, a wider set of services to the customers they have already acquired. So get them to start transacting in mutual funds, start cross-selling loans on your platform. I think that's a more sustainable model rather than, continuing to milk this entire F&O trend is my personal answer. I don't know what the future actually, I don't know how it is going to actually play out. That's the interesting part.
Thanks, Kedar. Very, very insightful answer. It will help a lot. Thank you, and excellent session. Really enjoying. Thanks.
Thanks, man. Thanks. So I believe lending is an interesting pocket, purely for the reason saying I believe the credit environment is very, very benign right now. And these are not my words, these are the words of the management. So if you generally, what happens in a benign credit environment is this: you keep growing, let's say, certain parts of your loan book pretty aggressively, but it doesn't really start to impact your balance sheet quality yet. So just look at the recoveries and upgrades that a lot of these tier 2, tier 3 lenders and some of these NBFCs are reporting. Their recoveries and upgrades are actually compensating for a whole chunk of the newer provisioning that they're doing. So in such a situation, what happens is credit cost looks very low, operating leverage starts to kind of play. So I think investors will definitely need to look at taking exposure to banks that are either large banks that are trading at a reasonable valuation, or you'll have to look at tier 2 banks which are, not yet fully priced. So I think that is one sector where people can definitely spend some amount of time. The second sector where I think things can probably continue to do well is definitely the economy facing back. So I think infra is coming out of a 10-year lull in India, and this has been our experience. Once a long gestation cycle like power, like let's say infrastructure changes, it doesn't reverse anytime soon, especially after a trend has been proven. Now there have been multiple false starts in some of these economy facing sectors in the past 10 years. So you look at 2014, you look at 2017, people were talking of a new capex boom, but it was just a false start because it fizzled out in about 2 quarters, 3 quarters. But this time around, what we are saying is it's a secular trend in order book growth. It was led by government spending in areas like, let's say, power transmission modernization, renewable energy policy. Then government started doing a lot of spending on the railway side. So now private capex is also, starting to take off. So I think that sector is one sector where I think the numbers will continue to do well, provided there is political stability going forward. So that's one big caveat over there. So these two sectors still look pretty well placed to us. So power, we believe, yeah. So power, we believe, transmission is probably the very, very interesting component, relatively speaking, because the unit economics distribution side, you can't really play too many themes, right? I mean, you still have state discoms that owe a lot of money, though things are being sort of cleaned up. When it comes to power generation, so power generation, we believe it's the sort of sector where you need a lot of upfront capital requirement. Then you need to sweat your assets over a period of time, and then you need to have absolute clarity on how the unit economics is going to change over a period of time. So we continue to be bullish on certain, I would say, component makers, critical component makers who supply to, let's say, power generation companies. We would probably want to buy certain stories which will help, I would say, the power transmission aspect of it. So I think it's very interesting, and something seems to be happening in wind energy after a long, long period of time. So that is one area where we need to do some amount of research as well. But I think wind energy, if I look at the commentary of some of the players like Sangvi Mover, you look at what Suzlon and Inox Wind is now starting to talk of. So I think these are sectors where if things have actually turned the corner, I think these trends, they don't reverse anytime soon. They tend to continue for a whole period of time, and that is where the market has actually trained investors to be very, very distrusting of some of these themes. Which, if it turns out to be slightly different this time around, I think valuations are still pretty reasonable. If order books can keep growing into their next 4 years, 5 years. Yeah. In fact, telecom, we don't really have a view on that. So telecom policy, we believe, is fairly complicated. So you had 3G, you had 4G, now we have 5G. So it's one of those sectors where I think we don't like the unit economics there. So if you can figure out a consumable play which is going to indirectly benefit from that. But the point is this: any sort of network optimization, any sort of, let's say, increase in the entire data throughput, it is going to benefit every single section. I think fintech is going to really take off. Look at what's happened in fintech. I mean, 6 years ago, you couldn't have really imagined that this sort of lending would be happening. You couldn't have imagined that people sitting in rural India would be consuming the sort of content that they are consuming today on their cell phones. So I think telecom, let me put it this way, we would probably look for indirect beneficiaries where you don't have too much of regulatory risk or balance sheet risk. The problem is this: in telecom, the government can come in and change the fortunes of the entire sector with a stroke of a pen overnight. So that is something that we are really, really paranoid about. So we haven't done too much of work on that sector, but always on the lookout for indirect stories. And so our house view has been that we don't want to deal with those uncertainties. So I mean, look at it this way: if you are a monopoly in an area which is actually very important for the government from a social point of view, from a, let's say, an economic point of view, eventually you're going to get regulated like a monopoly. You will be treated like an extension of the government arm. And if I look at the trend in regulation in India, I mean, look at it across institutions, I think there is a clear trend towards higher regulation. There is a clear trend towards higher regulation. So ideally speaking, we wouldn't want to be invested into those businesses. But if you are invested, I guess once the government takes a decision, usually they don't reverse it. It's very difficult for a government to go and admit to it saying this was a misstep. So I guess that's one risk that people kind of, you have to decide, do you want to live with those risks or not? Yeah, sure. So there's just a set of, let's say, top set of points that I can quickly cover in the next, say, in the next 5 to 10 minutes. So is my line any better now, or is it still the same?
Thank you. Thanks, Prince. Thanks, Kedar, for sharing your insights. Kedar, you were talking about like how technical analysis has helped you in stocks which are already making new highs. But that may not be applicable for stocks where you have a pessimism right now. So is your experience, am I right in that assessment where you're saying the same thing, or did I got it wrong? Just wanted to confirm.
Yeah, so when it comes to stocks which are already in the grip of pessimism, so sometimes what tends to happen is the same thing tends to happen. You will see a sudden volume spike coming in.
Yeah. Mm-hmm.
You will see the price moving 10%, 15% for absolutely no reason. And this tends to be more pronounced in some of the small and mid cap counters because, as you know, once a stock goes into stage 4, there's an absolute fall in the total volumes as well. So usually you need to look at it as a sign saying there is some big institutional counter over there which is probably making a bet saying fundamentally things are going to improve in the next 2 to 3 quarters.
Got it. Okay.
So the rules apply at the top and at the bottom as well. It's just that at the top, what tends to happen is your rear view mirror looks very, very clean, but the future is kind of uncertain, correct? Whereas if you come at the bottom of a cycle, it's exactly the reverse. The rear view mirror looks very, very dirty. It's a question of when the fog in front of your windscreen when you're driving is going to actually clear out. And you have no way of assessing that. So, end of the day, at the bottom of a cycle, it is always a probabilistic gamble, or it is somebody who has that information. Somebody who sort of, done the entire work, done a lot of scuttlebutt, done a lot of qualitative thinking, spoken to the supplier, spoken to the customer. He is making a bet with his money, saying next 2-3 quarters we think things are going to significantly improve. So that is something you should take very, very seriously, and sort of revisit your models. Always revisit your models and ask yourself, what seems to be happening here? Is there anything that I'm actually missing out? What kind of probabilistic gamble is this person actually taking? So thinking in terms of that, if not anything else, it actually helps you cover up for a whole bunch of blind spots.
Thank you. Thanks, Kedar, for sharing.
Yeah, so I'll just quickly cover a few points. So I think one thing that every one of us needs to sort of appreciate is this. Every new positive cycle, I'm talking of the overall market, every new positive cycle will usually bring forth a newer set of leaders. So one of the mistakes that a lot of people tend to do is at the beginning of a new run, they tend to go and buy the stalwarts of the previous bull run just because they have fallen 30%, 40% from the peak. So they think this is very, very cheap. But then that can work, but it is usually suboptimal because in those stocks, you will never really see that sort of an acceleration or that sort of a re-rating that is coming through. So what we would suggest is always do the FA work before you start looking at technicals, especially if you're zoned in on a story. But if you want to identify pockets where you think you want to do the FA work in the face of paucity of time, you can always look at relative strength of a particular sector and start doing your work over there. So we would suggest do the fundamental work, but also have a secondary approach that always enables you to estimate the supply demand situation in terms of what is happening in that particular stock. Because stock outperformance usually happens. It happens only when there is a very, very strong buying force, and buying force comes in only when the expectations going forward are markedly better than the previous history. So you will have to sort of give it a lot of importance. So you need to have this framework that enables you to estimate the supply demand situation. So we would say pay special attention to stocks that are making 5-year highs, especially if you have something like, let's say, a near vertical rise. So I guess in TA parlance they call it a breakaway gap. So they call it a breakaway gap. So a stock that is stuck, let's say, between 500 and 700 for 3 years. So suddenly the stock opens above the boundary of 700, it opens the day at 750. In such cases, it is in absolutely your best interest to go and revisit your fundamental models. If you haven't done the work, start doing the work on priority ASAP. Chances are those things usually tend to work out very well. So some of the skills which I guess people who haven't done too much of, I would say, work on the technical side is this. So reading of basic candlesticks in combination, I would say, with simple patterns. So higher highs, higher lows, lower highs, lower lows, basic moving averages, basic price volume information. Every weekend, just pull out 10-15 charts and just stare at it. And ideally, you should do it for stocks that you already understand well in terms of business, so that you can correlate what's happening in the business, what is the stock performance, then go back to the previous quarter earnings, ask yourself what was the earnings coming in, what was the stock reaction post that. So it is kind of possible to build some sort of a intuitive pattern recognition framework for this. You want to call it TA, you want to call it something else, it's absolutely true. So to just reiterate, I think TA adds great value at the top of a cycle because everything looks brilliant. But technically, if you can recognize the first signs of distribution, that tells you, okay, fine, I don't want to exit right now, but I need to be very, very clear about my exit criteria. So stage 3 stocks, TA, always be on the watch out for stories after you have made a lot of money. Whereas At the bottom of a cycle, TA sometimes can tend to misguide you because TA tells you to wait for confirmation. TA tells you to buy only above the 200 DMA, but the off the bottom prices will probably already be higher, 30%, 35%. So the point is this: there are sometimes you'll get the feeling that there's a lot of contradiction between what various methodologies are telling you, which is where I think personalization, coming up with your own methodology of what works for you, is very, very important. Once you kind of hit that sweet spot, I think it's just a question of executing well for over 2 years, 3 years, and then seeing the value addition actually coming through. So read everything, but eventually you'll have to come up with your own methodology as to what really works for you over the medium term and over the long. So I guess these are the points that I quickly wanted to cover. Yeah, so our view on IT sector is very clear. We want to watch for what the managements do rather than what the management say. What is more concerning to us at this point of time is the fact that Q3, Q4, there has been zero hiring across it. I mean, when was the last time you saw 2 quarters where the employee count at TCS was steady, employee count at TCS fell? So industry is not hiring at all. I mean, when you hire people in IT services, it is like a business doing capex, right? So if I have a management that keeps telling me everything is fine, people are obviously reevaluating, we are waiting and watching. But if you are not hiring people, that tells me everything that I need now. So IT, I think, will continue to have a little bit of consolidation because, once again, you need to understand the IT buying process from the customer's point of view. People are getting fired in the US. You talk to people who are working in sectors that are doing well, everywhere IT budgets are on a freeze. People are being laid off, right? So, in the face of uncertainty that surrounds, let's say, an IT procurement manager, why would he want to take a decision that can boomerang against him or against her? So people generally tend to wait for the entire stability to sort of, arrive from their own point of view. Then you have IT budgets that are starting to, get released once again. So I think this entire cycle usually takes a couple of years to play out. So 2023 was a pretty average year for the IT companies, but numbers wise, if you see, H1 was fine. H2 is where the entire slowdown started reflecting in the P&L. So our worry is from here. This slowdown in the P&L, if it starts to, let's say, affect the order book as well, if the pace of deal wins in terms of TCV, it starts to slow down, if existing large deals start to get cut down into smaller deals, and if the TCV starts coming down, then we would say stay away for another 1 year. So right now we're in a wait and watch mode. Ideally speaking, we want to ensure that the pace of deal wins doesn't really fall down. And once people start hiring once again, so keep your eyes and ears open around you. If you can figure out that IT hiring has once again started, that would be the time to ideally start taking IT positions again. Maybe not right now. And this answer applies obviously to the IT services, the large IT services.